Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll be discussing how artificial intelligence is affecting the stock market and what opportunities and risks investors need to be aware of. You've likely heard of a group of stocks known as the Magnificent Seven, which includes Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. This group now makes up about 35% of the entire S&P 500 and are the largest companies in the world. While it's tempting to focus on these companies since they've performed well recently, investing for long-term goals requires a thoughtful approach to both risk and growth. Over the next few minutes, we'll explore historical patterns of market concentration, explore current valuations, and discuss how to balance opportunities with concentration risk. First, you might think that AI has little in common with railroads, but history shows that transformative technologies often follow similar patterns. In the 1860s, railroad stocks dominated American markets much like technology stocks do today, creating market enthusiasm and rising valuations that would sound familiar to modern investors. This pattern has repeated many times across history. The dot-com boom of the 1990s provides perhaps the clearest recent example. Each of these waves followed a similar pattern of skepticism, rapid adoption, market enthusiasm, and eventual integration into the broader economy. Many dot-com companies did fail in the late 1990s and early 2000s, but many others went on to become today's technology leaders. So, what matters for long-term investors is less the specifics of each company and instead the impact that these new innovations have on the broader market. AI, for instance, is being adopted by many companies, and the hope is that this boosts productivity and efficiency over time. So while stock prices of individual companies may rise and fall quickly, it takes much longer for the full economy-wide effects to be felt. Next, it's important to focus not just on the AI story, but on the valuation levels that investors are paying for it. Today, the overall S&P 500 is trading at 22.5 times price-to-earnings ratio, a level that is approaching the all-time high of 24.5 times during the dot-com boom. This means that investors are paying a premium that assumes these trends will continue at the same pace. The question isn't whether AI will matter, but whether these valuations are reasonable. This is especially true since investments in AI infrastructure are measuring in the hundreds of billions of dollars. This exceeds the entire GDP of many countries. It has also driven the valuations of companies such as Microsoft and Nvidia to $4 trillion. Companies like these are sometimes known as hyperscalers, since they are rapidly building the computing infrastructure needed to support AI applications. However, markets often overestimate the speed at which these transformative technologies will generate profits. The 1990s offer a cautionary parallel. During that decade, some investors believe traditional valuation metrics no longer applied to internet companies. Of course, we all know how that ended. When reality did not match expectations, the Nasdaq fell 78% from its peak. Finally, this leads us to concentration risk. Since the Magnificent Seven now represents such a large portion of the major market indices, nearly all investors have these stocks in their portfolios. For those focused on technology stocks, their portfolio allocations may be greater than intended. Allocating too much of a portfolio to just a few investments creates what is known as concentration risk. This is the opposite of diversification. This is a problem because even great companies can experience periods of underperformance. The point is that financial success isn't about picking stocks, but maintaining an appropriate portfolio balance aligned with your long-term goals. Holding a balanced portfolio that matches these goals is what matters. We hope you found these insights helpful. If you would like to discuss these market trends or how they impact your portfolio in any more detail, please don't hesitate to reach out. We look forward to speaking with you.